So, what happens when a house you've inherited sells for a lot more than its probate value? It's a common situation, but honestly, it can bring a whole world of confusion. Well, you're in the right place. This guide, put together by the experts over at My Tax Accountant, is going to break it all down for you. Nice and simple. Let's get right into it.
Just imagine this for a second. You're sorting out a loved one's estate. You get the house valued for probate, and then it sells for a much higher price. And look, on the surface, that sounds brilliant, right? More money. But it can also land you with a surprise tax bill from HMRC that you just weren't expecting. It happens all the time, and knowing what to do next is absolutely crucial.
All right, so here's how we're going to tackle this. We'll start with a real-world dilemma. Then we'll solve the probate valuation puzzle and get really clear on the two different taxes you need to know about. After that, we'll dive into your strategic choices, look at how to handle HMRC, and we'll wrap up with exactly what you need to do next. Okay, to make this all real, let's talk about Sarah. She's a freelancer based in London, and she's the executor for her mom's estate. Now, she's on top of things, but like most of us, she's not a tax guru. She's also juggling the pressure of doing the right thing for her family, and all this while she's still grieving. It's a lot, and she's just been hit with this exact problem.
So let's look at the actual figures in Sarah's case. Her mum's house was valued at £300,000 for probate, but just 6 months down the line, it sold for $400,000. That's a massive £100,000 difference. And that's created the big question, what on earth does this mean for the tax bill? Let's follow her journey to find out.
Right, first things first. Before we even talk about tax, we've got to get our heads around the most important piece of the puzzle, the probate valuation. You hear the term thrown around a lot, but what it actually is and why it's so important can be a bit of a mystery. This number is the starting block for everything else.
So what is it exactly? Well, simply put, the probate value is the property's open market value on the exact day the person passed away. It really is a snapshot in time. It's not what the house might be worth a year later or what it was worth 5 years ago. It is this specific figure that HMRC uses as the starting line to work out the inheritance tax for the whole estate.
And here's why this matters so much. If a house sells for a lot more than that probate value, especially in a short space of time like Sarah's 6 months, it's like a big, flashing red flag for HMRC. They're going to start asking questions, wondering if that first valuation was a bit on the low side. And that's when things can get tricky.
This brings us right to the heart of the issue, what we call the two-tax tango. See, this whole situation isn't just about one tax. It's about a dance between two different UK taxes, inheritance tax and capital gains tax. And understanding the difference between them is the key to making the best financial decision.
So let's really get this straight. Inheritance tax, or IHT, is based on that snapshot value of the whole estate on the day of death. But capital gains tax, or CGT, is totally different. It's a tax on the gain, the profit basically, that's made after that date. So IHT is the snapshot, CGT tells the story of what happened next.
And, the numbers involved here are, well, they're pretty eye-watering. For the 2025/26 tax year, the main inheritance tax rate is a whopping 40%. And capital gains tax on a property like this isn't far behind at 28%. The taxman takes a pretty serious slice, which is exactly why your strategy here is so important.
Okay, but wait, it's not all doom and gloom with inheritance tax. There's something called the nil rate band. For 2025-26, that's $325,000. Think of it as a tax-free allowance. It means the first $325,000 of an estate's value is taxed at 0%. It's only the bit of the estate's value that goes over this line that gets hit with that 40% rate. So knowing if the estate is near this threshold is everything.
Oh, and here's a fantastic pro tip from the team at My Tax Accountant. If you spend money doing up the property after death but before you sell it, say you fit a new kitchen or fix the roof, you can often deduct those costs from the capital gain. That directly lowers your tax bill, so you absolutely have to keep every single receipt and record of that work.
All right, so we've got the basics down. Now we come to the crunch, the big decision an executor like Sarah has to make. She's trying to pay the right tax, but also trying to get the most for the beneficiaries. Stay with me here. This next part is where most people get stuck, and understanding this choice is the key to the whole thing.
Okay, let's look at this table. Sarah basically has two paths she can take. Strategy 1, stick with the original £300,000 value. This creates that £100,000 gain, and after the tax-free allowance, leaves a capital gains tax bill of £27,160. Ouch.
Strategy 2, she can ask HMRC to amend the probate value up to the £400,000 sale price. This wipes out the capital gain completely, so the CGT bill is zero. But, and it's a big but, it might push the total value of the estate up, which could mean a bigger inheritance tax bill. It's a trade-off. Now, sometimes it's a no-brainer. If the whole estate is still well under that £325,000 IHT threshold, even with the new house value, then amending is the obvious choice to save on tax.
So let's say you decide amending the value is the way to go. What does that actually involve? Well, first you need proof. That could be the sale contract or a proper valuation from a chartered surveyor. They're called RICS surveyors. Then you fill out a special form for HMRC called a C4 corrective account. You send that off with your evidence, and then HMRC will take another look at the estate for inheritance tax.
Okay, let's talk about dealing with the taxman himself, HMRC. The trick here isn't just knowing the rules. It's about being organized and on the front foot. Getting this right will save you so much stress, trust me. Okay, if there is one number you take away from this today, it's this one. 60. 60 days. If you end up needing to pay capital gains tax, you must report it and pay it within 60 days of the sale going through. This deadline is absolutely rigid. Miss it, and you're looking at penalties and interest. It is a very, very tight window.
So to keep you on the straight and narrow, here's a little best practice checklist. First, get a proper RICS valuation right at the start. It costs a bit, but HMRC takes it way more seriously. Second, keep records of absolutely everything. Be ready to explain your numbers. And this is a big one. Never ever deliberately lowball the valuation to try and save tax. The penalties are no joke. And really, talking to a pro early on is always the smartest move.
Phew. Okay, we have covered a ton of ground here, from valuations to tax strategies. So let's pull all that together and quickly recap the absolute key points you need to remember. So let's boil it all down to 4 essential takeaways. 1, accuracy at the start is everything. A good valuation can prevent a world of pain later on. 2, remember, it's a strategic choice. You either pay the capital gains tax or you amend the probate value and see what happens with inheritance tax. 3, move fast. That 60-day deadline is not a suggestion. And 4, please, don't try to do this all on your own. It's complicated, and professional advice isn't a luxury, it's a necessity. Right, and just a very important point here, this guide is for general information, but everyone's tax situation is different. So please don't use this alone to make financial decisions. Before you do anything, you really must talk to a qualified professional.
So if you're in this situation and need advice that's tailored just for you, we recommend getting in touch with an expert. The team at My Tax Accountant live and breathe this stuff. You can give them a call on 0208-570-8531 or drop them an email at info@mytaxaccountant.co.uk. Look, trying to navigate an estate when you're going through a tough time is hard enough without having to worry about complex tax rules. But having the right knowledge in your corner makes a huge difference. So, where can you go from here?
If you want to read through all of this in more detail, you can find the full article over on the My Tax Accountant blog. The link is right there on your screen. And for more clear, helpful guides, just like this one, make sure you hit subscribe on their YouTube channel. Thanks so much for watching.